Imagine earning interest just by using your checking account. Sounds unbelievable, right? But that's exactly what a high-yield checking account promises. The catch? Not every high-yield account is worth your time. Some look good on paper, but quietly drain your money through fees or conditions you didn't notice. Today, I'll walk you through how to choose the right high-yield checking account so your money actually grows instead of disappearing. Number 1. What exactly is a high-yield checking account? Think of a high-yield checking account as a regular checking account with a turbocharger. It does everything your normal checking account does. Lets you deposit paychecks, pay bills, and swipe your debit card, but it also pays you interest. For example, while most traditional checking accounts pay close to 0% interest, a high-yield checking account could pay anywhere from 2 to 6% annually. That means if you kept $5,000 in your account, you could earn up to $300 a year, instead of just a few pennies. But here's the twist. Those higher rates come with conditions. You might need to make a certain number of debit transactions each month, set up direct deposits, or maintain a specific balance. Miss one requirement, and your high yield could instantly drop to almost nothing. Number 2. Why banks offer high-yield checking accounts? You might wonder, why would a bank pay me more interest? Simple. They want loyal customers who keep their money active. By rewarding you with a higher interest rate, the bank gets consistent deposits, regular spending, and your long-term commitment. It's a win-win if you meet the conditions. But if you slip up, the bank saves money by paying you less interest. Think of it as a challenge. If you play by their rules, you win big. For example, Bank A might offer 5% interest, but only if you make 15 debit card purchases every month. If you forget and make 14, you'll earn less than 1% for that month. So, the bank wins when you miss the fine print, but so can you if you're organized. Number 3. Check the annual percentage yield, APY. This is where many beginners get confused. The annual percentage yield, APY, tells you how much you'll earn in 1 year after compounding interest. A higher APY looks great, but always read the fine print. Some banks advertise high APYs, but only apply them to a limited balance. For example, a bank may pay 5% on the first $10,000, but only 0.2% on anything above that. If you deposit $20,000, half your money will earn far less interest than you expected. The lesson? Always check how much of your balance qualifies for the high yield rate. Number 4. Look out for monthly requirements. This is where most people lose the high-yield game. To qualify for the advertised APY, banks usually set activity requirements like making at least a certain number of debit card transactions per month, setting up direct deposits, logging into your account online regularly, receiving electronic statements instead of paper. It might sound easy at first, but missing even one small task could drop your APY dramatically. For example, say you earn 4% interest if you make 12 debit purchases monthly. You make only 11, and suddenly your rate drops to 0.1%. That's like running a marathon and tripping 5 feet from the finish line. So before opening the account, make sure you can realistically meet those conditions every month. Number 5. Watch out for fees. Some high-yield checking accounts come with monthly maintenance fees, ATM withdrawal fees, or foreign transaction fees that eat into your interest earnings. Let's say you earn $10 in interest each month, but pay $12 in fees. You're actually losing money. Many online-only banks have zero monthly fees and offer free nationwide ATM access, making them great options for high-yield accounts. If you travel often, also check if the bank reimburses foreign ATM fees. Remember, it's not about how much you earn, it's about how much you keep. Number 6. Compare online banks versus traditional banks. Online banks often offer much higher APYs because they don't have physical branches to maintain. Traditional banks, on the other hand, provide in-person services and sometimes better customer support. For example, an online bank might offer 5% APY, while your local bank offers only 0.5%. If you're comfortable doing everything digitally, online banks can be your best bet. But if you prefer walking into a branch and speaking with someone face-to-face, that convenience might be worth the lower rate. The good news? Many people use both, keeping one online high-yield account for savings and a local one for daily spending. Number 7. Don't forget FDIC insurance. Never deposit your money into a bank that isn't insured by the Federal Deposit Insurance Corporation, FDIC. FDIC insurance protects your money up to $250,000 per depositor per bank. That means even if the bank goes out of business, your money is safe. Always check for the FDIC logo on the bank's website or branch. For credit unions, the equivalent protection comes from the National Credit Union Administration, NCUA. If you don't see these protections, walk away immediately. Number 8. Consider accessibility and usability. Imagine earning great interest, but struggling to access your own money. Not ideal, right? Before choosing a high-yield checking account, test how easy it is to use their mobile app, transfer funds, or contact customer support. Try to find reviews from real users. Are mobile deposits fast? Does the app crash often? Are customer service wait times long? A good example, banks like Ally or Capital One 360 have sleek apps, instant transfers, and user-friendly dashboards, making them favorites among digital users. A frustrating experience can turn even a high APY into a daily headache. Number 9. Think about long-term goals. Before choosing any account, ask yourself what you're actually trying to achieve. Are you keeping money there for everyday spending, or do you want it to grow slowly over time? If it's for spending, focus on convenience, ATM access, and quick transfers. If it's for saving, look for accounts that reward larger balances or consistent deposits. For instance, someone using the account for daily expenses might prefer a 2% APY with easy access to cash, while another person focused on saving could aim for a 5% APY with stricter rules. Your best account depends on your habits, not just the advertised numbers. Number 10. Check if there's a cap on interest earnings. Some banks set a maximum balance limit for earning the high APY. For example, a bank might pay 4% on the first $10,000, then drop to 0.1% after that. So, if you're planning to deposit a large amount, you might earn more by splitting your money across two different high-yield accounts. This simple trick can help you make the most out of your savings while staying under each bank's limit. Number 11. Evaluate bonus offers carefully. Some banks lure you in with shiny sign-up bonuses. They might say, get $200 for opening a new account. Sounds great, right? But look closer, there's often fine print. You might need to deposit a minimum amount, keep the account open for several months, or make a set number of transactions to qualify. If those conditions fit your lifestyle, go for it. But don't chase bonuses that require you to jump through hoops that don't match your usual habits. A bonus isn't a bonus if it costs you time, effort, or money. Number 12. Read real user reviews. Before you commit, take 10 minutes to search for reviews online. Platforms like Reddit, Trustpilot, and Bankrate are full of real experiences from customers. You might find helpful insights, like whether the bank's app is glitchy or their customer support is unresponsive. A 5% APY means nothing if you can't reach support when something goes wrong. Use other people's experiences as your preview before you make the leap. Number 13. Automate to stay qualified. Since most high-yield accounts require direct deposits or a set number of transactions, automation can save you headaches. Set up automatic transfers, bill payments, or debit purchases to ensure you meet monthly requirements without stress. For example, you can automate a few small recurring payments, like your streaming subscriptions or phone bill, to meet the transaction requirement easily every month. Once it's automated, you'll consistently earn the high rate without having to think about it. Number 14. Always recheck the rate. Here's a little secret banks don't talk about. Rates can change anytime. A bank offering 4% today might lower it to 2% next month. So, check your account periodically. If the rate drops significantly, don't hesitate to move your money elsewhere. It's your money. Make sure it's always working hard for you. Number 15. Understand tiered interest rates. Some banks use a tiered interest rate system. That means the more money you keep in your account, the different interest rate you'll earn for each level. For example, a bank may pay 2% for balances up to $5,000, 3% for balances between $5,000 and $10,000, and 4% for anything above that. This can sound attractive, but make sure you calculate the actual blended rate before deciding. Sometimes the difference between tiers is so small that it's not worth locking up more of your money there. Understanding how the tiers work helps you know exactly how much your balance will earn. Number 16. Check how interest is compounded. Not all banks calculate interest the same way. Some compound it daily, some monthly, and some quarterly. Daily compounding means your money earns interest on both the principal and the interest added every day. Over time, that small detail can make a big difference. For example, if two accounts both offer 4% APY, but one compounds daily and the other monthly, the daily compounding one will slightly outperform. Always pick the one that compounds more frequently. It's like adding a little turbo boost to your savings. Number 17. Review overdraft policies. Overdraft fees can quickly cancel out your earned interest. Some banks charge $30 or more every time your balance dips below zero. Others offer overdraft protection or automatically transfer money from your savings to cover shortfalls. If you're someone who occasionally forgets to check your balance, look for banks that either don't charge overdraft fees or have a generous buffer. That small detail could save you hundreds over the year. Number 18. Make sure it fits your spending style. Every person uses their checking account differently. If you make frequent debit transactions, pick an account that rewards you for that activity. But if you mostly pay bills online or use credit cards for rewards, you might not meet the debit transaction requirements needed to earn the high yield. Matching the account to your actual lifestyle ensures you'll earn the advertised rate without changing your spending habits drastically. It's about making the bank fit you, not the other way around. Number 19. Look for account flexibility. Some banks penalize you for too many transfers, withdrawals, or external transactions. That can be frustrating if you like moving your money between accounts often. Choose a high-yield checking account that offers flexibility in how often you can transfer, pay, or withdraw. For example, if you plan to use it as both a spending and saving account, find one with no limits on electronic transfers. A flexible account gives you freedom while still earning strong interest. Number 20. Learn about customer service hours. When something goes wrong with your money, you want help fast. Some online banks only offer support through chatbots or limited live agent hours. Others have 24/7 phone service. Before opening an account, test how quickly the bank responds to inquiries. A great rate means nothing if you can't reach someone when you need to fix a problem. Good support equals peace of mind. Number 21. Check for partner ATM networks. If you travel or move around often, ATM access can make a big difference. Many online banks partner with large ATM networks to give you free withdrawals across the country. Some even reimburse out-of-network fees each month. Always confirm how many ATMs you'll have access to before opening the account. The fewer fees you pay, the more your earned interest stays in your pocket. Number 22. Make sure it integrates with your budget tools. If you use apps like Mint, Enab, or Personal Capital, you'll want your new bank to sync easily. Integration helps you track spending and income automatically without logging in every time. This is especially helpful if you're building a financial routine or trying to hit specific saving goals. A bank that connects smoothly with your budgeting tools can help you stay disciplined without extra effort. Number 23. Review the bank's reputation. Before trusting a new bank with your money, research its history. Check if it's been involved in major service outages, security breaches, or customer complaints. Websites like the Better Business Bureau or Consumer Affairs show how banks handle issues. Choosing a well-reviewed bank ensures you're putting your money somewhere safe and reliable. Number 24. See if they offer extra perks. Some banks include small benefits that add real value. These can include cash back on debit purchases, early paycheck deposits, or free financial education tools. For example, some banks let you access your paycheck 2 days early if you set up direct deposit. Those perks might not increase your APY, but they can make daily banking smoother and more rewarding. Sometimes, the little extras are what make an account stand out. Number 25. Evaluate mobile check deposit limits. If you deposit checks frequently, pay attention to how much you can deposit through the app. Some banks limit mobile deposits to a few $1,000s per day or month. If you earn freelance income or receive larger checks, these limits could be inconvenient. A bank with higher or unlimited mobile deposit limits gives you more flexibility and less hassle. It's a small feature that can save you big time. Number 26. Check how long funds are held. Some banks hold deposited checks for several business days before letting you use the money. That can be frustrating if you need access quickly. High-yield checking accounts at smaller or newer banks sometimes have longer hold times for security reasons. Make sure you understand how long deposits take to clear before choosing your bank. Faster access means fewer financial bottlenecks. Your checking account should reward you, not the other way around. By understanding the fine print, comparing options, and automating your habits, you can easily find a high-yield checking account that truly pays off. So, what's the one feature you think is most important when choosing a bank? Interest rate, accessibility, or trustworthiness? Share your thoughts in the comments below.